So we basically know what receivables are. One thing, claims of the business held against other people, money, goods, or services can be receivables. We could classify these as either trade receivables or non-trade receivables. And I talked about that just really briefly when we were talking about cash equivalents. Trade receivables tend to be the most significant receivables an enterprise has. I would take off notes receivable here. Notes receivable are a little different. I'm not sure why I put that in, but they tend to be the most significant in terms of dollar value. These are customer-based receivables. So I sell goods and services to people outside the company, my customer base. These are trade receivables, right? When you were working in intro to financial accounting, a lot of those were trade receivables. We also have non-trade receivables, non-customer based transactions, promises to pay, maybe are the advances to our employees, advances to our subsidiary companies, dividends receivable. So we own a stock of another company. They pay dividends when they declare those dividends prior to them cutting us a check. Those are dividends receivable and they're non-trade. Interest receivable, right? Arising from loans we've made, investments we've made that are earning interest. Until that interest is paid, it is receivable, and we accrue a receivable as time passes until the interest is paid. If they are material, then we report them on the balance sheet. Then it has to be recognized. If it's not material, they can just be disclosed in the footnotes. And this is an issue, again, between materiality can determine whether information is recognized or disclosed. So if it is material, if it is a big deal, if it's significant, we recognize. If it's not such a big deal, we disclose. Really want you to understand the difference between those items. Accounts receivable themselves, they are oral contracts. They could be sometimes loosely written contracts, but they tend to be oral agreements between a purchaser and a client, or sorry, between a client and the company for goods or services. They're less formal than notes receivable, but still enforceable. Notes receivable have formal dates like maturity dates. Receivables, can be paid anywhere from the next day to 6 months later. So there's no rigid date. They have notes have terms of interest, and when things are going to be collected, maybe there's semi-annual payments to be made on a note to the company. We're talking about a note receivable, but basically it's more formal. There is a maturity date and there's interest, then it becomes a note. If it's less formal, oral, then it's an account receivable. They are classified as current assets. There can be exceptions, but this tends to be the case. They are listed, remember, on the balance sheet at net realizable value, sometimes made into an acronym, NRV. Net realizable value is the ledger balance of my accounts receivable reduced by the contra accounts. There's a couple of contra accounts that we'll learn about in this chapter, and we'll talk about. ADA, the allowance for doubtful accounts. This represents our estimate of clients, or I'll call them customers, who will be unable to pay. And our allowance for sales returns, which is estimate of returns from sold products. So we have our total ledger balance of receivables that includes every single item that we've sold on credit. So this is the ledger balance. And that has all the stuff, even people who won't pay me, even people who are going to return, which means that we're going to end up estimating how many of these people will not be able to pay me and how many of these things will end up as returns. I expect you to be familiar with recording sales on credit, collections on credit sales, writing off uncollectible accounts, reinstating accounts that were previously written off, and recovering them and recording bad debt expense. If you're not, there is an appendix at the very end. And yeah, I'm not going to get to the end of these notes today. Sad. But this appendix, you need to read through and remember and practice through these various basic journal entries that come from intro, because the stuff that I want to talk about now is going to make small key changes to those items. Okay. So one of the things that we're going to talk about that's a little bit of a complexity is a discount. We can have what we call a trade discount, and that's going to be different than what we're going to discuss in just a second, which is a cash discount. So a trade discount is a reduction from the list price, for example, for a bulk order. They're just striking it off the catalog price, and because there is a 100% certainty of discount, right? We're not even charging them the full price. We're charging them 98% of the full price, and that's for certain. Then we're going to bill the customer net of that discount and record sales revenue net of that discount at the point of sale. So if there's a full price of 100,000 and we are offering a 2% reduction, then we debit accounts receivable for 98,000 at that 2% discounted price. And our sales revenue is going to be 98,000 as well. And we only do that. I mean, no matter what happens in any of the other discount, the other type of discount we're going to talk about, since it's 100% certainty that it's going to happen, we just take it off the price. Now, a cash discount, sometimes just called a sales discount, is different. It's an option. It's in the option of the customer to get or not get the discount. So it's no longer certain. Right? And the reason it's no longer certain is we're trying to get them to pay promptly. So in order to get them to pay more quickly, we might offer them some sort of a term. And this is the general way that we write it, the coded way that we write. 2% discount if paid within 10 days, 2/10, 2% discount if the customer pays me in 10 days. Otherwise, the full amount, N, is due in 30 days. Right? And if they don't pay me within 30 days, there doesn't tend to be, depending on the company, maybe they have a policy that they start charging something, or maybe, but typically it is just basically they're going to start hounding you. Eventually they'll probably turn you over to a debt collector or something like that. But because there's an option, and because we're not sure, will the customer pay? Won't they pay? We have two different methods of going about recording these items. We have a gross method and we have a net method, and companies can use either. So we'll talk about the two methods and how the accounting differs between them. So under the gross method, if you haven't gotten this yet in business, if we're talking about what's my gross income, right? Well, that tends to be like, well, what am I paid before they take out all the taxes? Right? It's not net of anything, it's gross. So this is the full amount. So the full amount method basically says record the sale and the receivable at their full amount. Do not apply the discount. So if I'm not applying the discount, what's the assumption? The assumption becomes the customer is going to pay a full amount. They're not going to use the discount, right? If they do take the discount, then we have an account that makes the numbers correct. Sales discounts taken by customers, right? They're violating our assumption. So we don't get the full $100 of service revenue or sales revenue. We only get 98% of it. Well, then we have to record a sales discount. And this is our very first, and I know it's a moment of celebration because it's a first, contra revenue. We've talked about contra assets. We've talked about contra liabilities. This is a contra revenue account. And it's reported in the income statement as a reduction of sales. And I should just put also revenue. Sales are reported net on the income statement, and sales discounts are one item that is deducted. We're going to talk about the other in part 2, sales returns. So let's look at, I'm just going to draw a T account. We'll talk about it, just write up sales discounts here. So sales discounts, remember, contra revenue. If we're talking about sales revenue, which is its parent account, and let's just assume that I have $100 in my sales revenue account, right? That's after all the activity in a period. The adjusted trial balance says $100, credit balance of sales revenue. Because sales revenue is a credit-based account, which means that credits increase it, debits decrease it. This is contra to that, which means that it has debit balance account. And let's say that the sales discounts were $2 for the period. Remember that we keep these things separate in the ledger. If this is my ledger, I have basically two accounts hanging out in this Excel file, this data formatted account listing. But when I go to report them on a financial statement, I combine the contra account with its parent account when I report, for example, on the income statement. Sales revenue net $98. Just like accumulated depreciation reduces the amount that I record PP&E at on the balance sheet, because accumulated depreciation is a contra account to the PPE. This is a contra account to a revenue account. Right? It is also closed at the end of every period. So just like sales revenue is closed at the end of every period, because it's a nominal account, it's a temporary account, it appears on the income statement, its contra is also a temporary account that needs to be closed. And what is the effect of a sales discount? Well, it's lowering net income. That's its only role, is when I debit sales discounts, I'm reducing net income, because instead of reporting 100 here, I'm only reporting 98. Under the net method, we record it net at the net amount, the full amount less the discount. Gross amount less the discount, or full amount less the discount. And if I'm just going to go ahead and record it at the discounted price, then my assumption is, hey, I'm not going to pay, or I'm sorry, I am going, that my customers are going to pay within the discount window. They're going to take the discount. There is no discount account, no sales discount account that is used under a net method approach, because the discount's already embedded when I record the sale. I already netted it out. Instead of recording a credit to $100 when I record that sell, as I did in the full or the gross method, I'm going to record sales revenue credit $98, because I'm assuming they're going to pay me within the window. Therefore, the discount is already in this account here, doesn't have to be counted again. However, now we have to have a special account if they don't take the discount. And this one is called sales discounts forfeited, and can also be called interest revenue. So in this case, this is just another revenue. Actually, and it is a other income. It's listed amongst our, not among operating items, but among the other income expense items in the income statement. So we don't have that same connection here any longer. This would be at 98. This would be a credit balance of $2 because it's a revenue account. So notice the difference between the top, where we assume they're not going to take the discount. We record at full price. They do take the discount, and then we reduce it to $98. Well, let's say we assume they're not going to take the discount. I'm sorry, we assume they are going to take the discount and they end up not taking the discount. Then it would be an income statement that looks like this. Income statement, sales revenue net $98. It's 98 not because we had a sales discount account like up here, but simply because that is already netted there. If they don't take the discount, right, we have we have cost of goods sold for an amount. We got operating expenses coming in. That gives us my operating income. And I didn't even write in gross profit, but that would be up there too. And then when we have other income expense, we would have this sales discounts forfeited for $2. So that $2 does not get input into the system until further down the line. Notice that the effect of people taking a discount and not taking a discount up here is in both operating income and net income because of where it's placed. It's deducted way up top in sales revenue. But if we don't make an adjustment for our method of or our assumption going wrong, then we will not know our assumption is wrong in operating income. It'll only be affected in net income, which would be down here after tax expense is taken out. So this is what I mean about you need to bring forward the things we talked about in the prior chapters when you're studying these new technical things. Because whenever we get accounting method choice, I'm going to be, you're going to find out pretty quickly that I like to test you guys on understanding not just how the journal entries are made between the two choices, but how will a financial statement be affected by the difference in the two choices, right? And so in this particular instance, net income isn't affected at all. It's going to reflect the same with the same set of facts if I use gross method or net method. But what will change is operating income. And so I want you to think through that, think through it while you're working the problems. I think, and I know actually, I remember looking at it and embedding a couple of those problems in your assignments. So I want to wrap up on just doing, a problem with sales discount accounting, and just working through it, putting the accounts down and showing you how the two are different. So Broncos, they're trying to decide what method of payment to use. So we're going to work at both gross and net method with them. On June 1st, it made sales of $50,000 with terms 3, 15, and 45. We get a 3% discount if we pay within 15 days. Otherwise, the full amount's due in 45. Prepare the required entries for Broncos under both methods, given this information and scenario 1, scenario 2. So the sale is that 50,000, right? This is my full price. And we're going to take the 50,000 under the gross method. We don't have to do any calculation because we're going to record the full thing as if they're not going to take the discount. So we got an asset with our receivables. We got net income with the sales revenue. Under the net method, we assume they're going to pay within 15 days, which means they get a 3% discount, which means that we're not going to record that at 50,000, but we're going to record that at 97% of 15,000, which is 48,500. We got accounts receivable and sales revenue, 48,500. This is just at 97% of full amount. Has that 3% discount already taken. Same things are affected, assets and sales revenue. Now, if the customer pays within the discount period, over here, we assumed that we were, so that's a check, right? That I just put a check there because it's like it validates our assumption. We don't need to do any special accounting. The accounts receivable are recorded at the net amount, and the customer only has to pay the discounted cash price, 48,500, and the accounts receivable is going to be at 48,500. But over here, we assumed that they weren't going to take a discount. That's why we said, hey, we're recording this receivable as if someone owes me $50,000 because they ain't going to pay in the discount. So this does not check out. It's a violation. That means that that's when we have to invoke the special account that we just learned about, sales discounts. So if they do pay within the discount period, they pay with discounted cash, or they pay the discounted cash price, 48,500, right? They took a 3% discount. Our accounts receivable, though, were recorded at 50,000, which means that we're not balancing. In order to balance correctly, we got to have that sales discount come in. And that's going to be 1,500. That's going to make up my difference. Cash, of course, debit increases assets. Recording the sales discount reduces net income. Accounts receivable reduces assets. Credit to accounts receivable does. All right. And then now we're going to have, the same situation with scenario 2, but just reversed. If they don't pay within the discount, well, then under the gross method, we made the correct assumption. This checks out. I debit cash. They're going to pay the full 100% price. And my accounts receivable are already recorded at that price of 50,000. Over here, our assumption was off. They didn't take a discount. And so when I credit accounts receivable, I can only credit accounts receivable for 48,500, even though I received the full cash price, 50,000. I can only record 48.5 because that's all I recorded up here. So now I need my second special account we just learned about, sales discounts forfeited, to take up the slack. We would have a reduction in assets here, an increase in net income here, and here my assets would go up. So just looking at this again, quickly thinking about, well, how does this look? How do we take this and how does it affect the income statement with the difference in how I report things? Let's say that, this was the only sale I made for the period. This is my sales revenue for the period. And let's take each scenario. So scenario 1, and we'll have gross, net. Scenario 2, the gross method and the net method. And I'll just have the sales revenue for both of these. And I'll make up an arbitrary cost of goods sold that never changes. And we'll have a gross profit. And we'll have our operating expenses. That'll give me income from ops. This is a good review of I'm just going to acronym that there. Income from ops. We got our pre-tax, our tax, and our net income. So let us assume that cost of goods sold is 30,000 in each of these. It is unaffected by any of our gross net or scenario assumptions. We'll just say operating expenses were $5 in each case. Again, not going to be affected by anything we do gross net scenario 1 or 2. So that's just, I'm just throwing those out there. Who cares? Remember, of course, this is sales revenue net, because now we need to add that to our thought, is that if we have any sort of sales revenue that's reported on the income statement, it is stated net of discount, right? Always. Because remember, under the net method, we just don't record, we just record the account sales revenue net of all discounts. And under the gross method, we have a contra revenue account that reduces it. So in this case, in scenario 1, under the gross method, well, what gets recorded as sales revenue? It would be the 50,000 less the 1.5K. So we would only record 48,500. In scenario 1 with the net method, we still record it net of that discount because we assume it when we make the sale. Okay, so same numbers, right? Yep, they're going to return the same gross profit, 18,500. We got some operating expenses. It brings them both down to 13,500. We're going to pretend like we don't have any interest expense. And because we're operating under scenario 1, there's no sales discounts forfeited in here. So that's not coming in where it would in our other income items between income from operations and pre-tax. So that really is just the pre-tax amount. There's nothing there. There's no other income or expenses to report. We got a 20% tax rate on that. And that would come to 2.7. And we would report based on that $10,800 of net income. So with this scenario, both report the same income from operations, the same net income, and the same sales revenue. In scenario 2, this is going to be a little different. So when they violate the assumption that when they don't violate the assumption that they are not going to pay within the discount window with the gross method, we have no sales discount in this, right? No sales discount. We only have sales discounts forfeited. So that results in $50,000 of sales revenue. But over here, we recorded it at 48,500. So we put that here. Remember, sales discounts forfeited is other income and expense. So it doesn't affect it until that area, we hit that area. That means gross profit here is 20,000. That means gross profit here is only 18,500. The income from ops would be 15,000. Here it's 13,500. So not only is it affecting my sales revenue figure, but it's affecting income from operations. And now we have the sales discounts forfeited. If it's other income / expense, it comes here. It's not over here in the gross method because they don't use that account. They assume they're going to take the full price. It does get added back here. So now both have 15,000 pre-tax income. 20% of that is 3,000 in both cases. And they both end up reporting $12,000 of net income. So notice that net income is never affected, right? This is the scenario. This is the actual transactions. Here they paid within the window. Here they do not pay within the window. Then gross and net presentation. If they pay within the window, no differences arise between gross and net presentation. If they fail to pay within the window, then we start having differences emerge. We have the differences emerge in the revenues recorded. We have differences emerge in the gross profit and the income from operations, but no difference in net income. So the reason why this net income is different from this net income is that here they're paying in a discount window, so we get less income. Over here, they're not paying, so we get more net income. But between the two methods, within each scenario, income is not different. So I know it's a lot. You need to start here, understand how to record these things, understand the accounts involved, understand where the accounts feed into, and then apply that and think it through our basis in terms of the foundation we built in the first couple of chapters. Okay. Thank you for taking the extra time today. And yeah, obviously we got a lot to talk about. And I'll talk about the estimating of bad debt expense on Thursday.